Alright, so back with another video on an example for a bullish type 1, a bullish, what do I even call it? A bullish lower time frame, higher time frame. Okay, let's get this right. It's a bullish higher time frame / lower time frame A+ setup entry model. Okay, great. All right, that's just what I'm gonna call it, and that's what it is on my screenshots. And but let's just go to the trade recap though. I didn't take this trade live, but I just want to make this video as an example of a future bullish A+ setup. So what are we looking for? Okay, so we're looking for sell side liquidity being taken, along with a market structure shift, a respect of a higher time frame fair value gap, and a retrace into an order block or displacement on the lower time frame, which is where your entry would be. But I didn't mention on the market structure shift on number 2, you're looking for a rejection off of a fair value gap after price has taken sell side liquidity. So let me just show you what I mean by that. Okay, the trade aside. Okay, so there's a fair value gap right here, and let's just find particularly where that is. 15 minute. Okay, on the 15 minute, there is a fair value gap right within the low of this daily low during Asian. So 18 o'clock, which is the open, and it creates this low, and price rallies and creates this range throughout Asian and London. And then we see price come and take out the sell side liquidity below this daily low, creating a new daily low, rejecting that with this candle and reaching higher, giving us bullish price delivery. So, we want to look for a long within this move right here. And this is an A+ setup because it meets all of our criteria and everything that we're looking for right here. So we have this fair value gap, right? And we're looking for price to take out the low, this low right here, go into the fair value gap, reject it, and then we can have an entry on the lower time frame. But going on to the 5 minute, we're going to see a little bit more. So on the 5 minute, price comes down, creates this low, creates some liquidity right here, and it takes the low right here. What did I say before? Price moves. One of the ways that price moves is to either hunt liquidity, generate liquidity, go to equilibrium, or to rebalance. In this case, we created liquidity, we took it out, we made a strong move up, and then we continued higher right here. But if you could see right here with this candle, its wick, it retraces to the open of this bearish candle, which would be an order block. And essentially an order block is a bullish order block is a bearish candle, a down close candle, followed by a large up close candle, an engulfing candle. But many people believe that the order block is you have to draw it at the wick. Sometimes it does go there and it respects it, but a lot of times it doesn't. The cleaner order block would be at the open of this down close candle once price closes above it with this candle. So if I put it on replay, right, another bar, price creates this low with the next candle. It goes above it, closes above it, and it engulfs it, right? But if you look at the line chart, right, this is going to tell you more about the market structure. So let's go on there. So look at that. Price opens here, closes down here, opens a new bullish candle right here, closes above here. This would be the order block right here. It's not the wick. You don't see any wicks on this line chart. You only see the market, the candle open and closes. The line chart only moves because of the open and closing of the candle. It opens right here, closes here, new candle, opens right here, closes right here. It doesn't account the wick. So let's go back to the candle chart, right? There's no wicks in here. Why would that wick be an order block? There's no structure to that wick. So I don't really trust wicks as much as I trust opens. And particularly for order blocks only. So this is your order block. And if you were trading this live, you would set a limit right here at the open of that order block. Set your stop. You can set your stop however you want, but you don't want to see price go down, take this right here at all. So you'd set your stop right here. And you would target 1 and 2. Target 1 and 2. Move on to the next candle. Boom, we get our entry. And we just wait, and price goes straight to our take profit for 1 to 2. That's how simple it is. That's how simple it is. But there's another thing. If you go in the 1 minute, within this engulfing candle, there was displacement in here. So you could have dropped down to the 1 minute and, drew out this displacement. And you could have taken an entry within that displacement. And that displacement happens to be at the order block as well, which is another good confluence for this particular trade. Well, but that's about all that I want to show for this trade. So remember, you're looking for some form of sell side liquidity being taken. And you're looking for a market structure shift where the price creates an order block. It respects that order block, comes into it, respects it, or a fair value gap or displacement, and then move higher. You don't want to see it go close to the open of this order block right here. You don't want to see it go there. It means that there's some more bearish momentum. There's more manipulation going on. Either that or manipulation. So you just want a straightforward bullish buy side delivery. And what do we see? If we jump to now, we see price completely taken out sell side, and it's rallying as we're speaking. The unfortunate part, I didn't catch this trade because I was making videos too. I was busy recording and writing things down and taking notes. But I'm just making this video for future reference for myself, and if it helps any of you, praise God. But yeah, this is the A+ setup. This is the A+ setup. There's 4 different confluences in the setup. And if you be process driven, if you trade with a process, you won't find yourself failing as much as you do. Because I used to just buy at random fair value gaps. When I started learning ICT, I used to just only buy random fair value gaps. Or I used to buy every fair value gap, and I'll lose every single trade. But when I first learned it, I thought I discovered the holy grail of trading. I thought fair value gaps were the holy grail of trading, because price would go into it, and then it'll respect it, and it'll move in your favor. Price will reverse from it. It'll respect it. But I didn't know that not all fair value gaps work. Like only 50% of fair value gaps actually work. 50% of them. But in our case, though, you obviously want to see a rejection of that. You want to see some more confluences, like the rejection and the sweep of liquidity. And then you would want to enter within that market structure. You'd like to enter within displacement, a fair value gap, slash fair value gap, and or an order block that's created with that move, which we see in this trade right here. But here's a key though. when you're in a trade, be process minded. You got your entry, you got your trade setup, you got your A plus setup. Now you need to learn how to take profits from the process. Because some of us, and I used to do this, we will have crazy profit targets that price will take a very long time to go to, or sometimes never go there. And price will come back like 1-to-1 and then go back to break even. And then now you were up profit. Now you're at zero. And then next thing you know, you've taken a loss because price comes down and even takes your stop loss. Or in a lot of instances, price goes to 1-to-2 because you're targeting 1-to-3. Price goes to 1-to-2. It doesn't, price goes to 1-to-2, retraces, goes to break even, and it hits your stop loss. When you were up 1-to-2 and you could have taken 1-to-2 or 1-to-1 at least, your problem is you're not taking profits. You want to hit the home run. You're just so caught up with hitting the take profit, hitting the even number that you were reaching for. You're so profit minded, you're not process minded. You have to be taking profits. That's the only way you're going to make money from this. As long as you follow your process and you're taking profits within that process, you'll be fine. But if you keep, if you play the game of idealism, like, oh, I want this trade to go to 1-to-3. I'm targeting 1-to-3 because my results say that 1-to-3 works. When in live, can you really handle holding 1-to-3? Especially when it takes a long time. Can you be up 1-to-2, price retrace completely to break even before going to 1-to-3? Can you handle that? Most people can't. And I've done this, and I know myself, it ruins my psychology. So I'd rather take those profits and run with it versus those profits, being in profit and completely losing it afterward, whether going to break even or going into my stop loss. I'm not waiting an extra 2 hours for it to go 1-to-3. No, I'm taking my profits and I'm going to enjoy that. I'm going to call it a day. That's where I stop. That's where it's done. I'm not going to allow any more emotional damage. I'm not going to allow any more emotional damage to take place in me waiting for a trade. Have you ever been in a trade and you're waiting for this trade, right? And it goes up, you're in profit. And it goes down, it goes to break even, and then you think you're gonna get stopped out, but you don't want that. So you keep holding on to the trade and you're waiting to see what will happen because you believe it'll go to 1-to-3. You believe that it's gonna reach to your ideal profit target. And until it doesn't and it hits your stop loss, you're sitting there thinking, what did I do wrong? Let me tell you, that's what you're doing wrong. You're being too profit-minded. You're not being process-minded. You didn't follow your process. Well, you followed your process with the entry and the trade and stuff, but you didn't follow the right process to make money. Because there's a process for trading, but there's a process for profiting. If your process is trying to hit 1-to-3s, 1-to-5s, maybe that works for you with your strategy. But for a lot of people, that doesn't work. You waiting an extra 2 or 3 hours for a trade to go 1-to-3. I'm not doing that. No. I got to do other things. I have a life to live. I cannot just sit and contemplate watching a trade. I've had this happen to me before. I'll be in a trade and I'll have something to do. But this trade has so much of my attention that I can't do what I need to do because this trade. Or sometimes I'll be in the trade and I'll do making something up, the chores or something like that. And I'll be completely distracted. Like, I'm not thinking about doing the chores. I'm doing the dishes, but I'm not really thinking about doing the dishes. I'm watching this trade. I'm on my phone. I got my phone right next to me. I'm watching that trade right now. I'm not really focused on what I got to do. You don't want to let that happen to yourself. You shouldn't even be feeling that in the first place. Why are you so tied to the outcome? You shouldn't be so attached to it. The reason why you're so attached is because you have this high expectation of the market that it's going to go to your take profit. No, it's not. No, it's not. The market will do whatever it wants. It will go to 90% of your take profit. It will never hit it. And it will go down and take your stop loss and take you out. The market doesn't have to do what you want it to do. The market's not an ideal place. So stop thinking like that. And the way for you to overcome this is to be process-minded, process-based, profiting. There has to be a process to it. If your trade goes to 1-to-1, and you should be okay with that. And even if it does go and lose, it goes to 90% to 1-to-1. It doesn't hit your TP, and it goes to stop loss, and it takes you out. You should be okay with that. You should learn from that. Take notes. Observe yourself. And you know what did it for me? Is that when I learned to be an observer. When you're focused on trading, you're focused on making money. You're focused on your trade not hitting stop loss. You're focused on whether or not the trade is going to hit your TP. All those things are in your mind, and it's taking you away from the chart. You're no longer looking at the chart. You're looking at your TP. You're looking at your stop loss. You're looking at your money. You're looking at your gains. You're looking at your P&L. You're looking at your account balance when you should be looking at the chart. The chart is what makes you money. The chart is what tells you what's happening and what's going on and what you should do and how you should react. But all these things are in your mind. You can't even make the right decision. You can't even take profits. And, that's why prop firms are the way that they are. We have this trailing drawdown. We have this profit target. You have to make 10% within 30 days. And then we'll refund you, and then we'll do this. And then if you make profit, we'll pay you out 80%, 90%, whatever. But the problem is most traders, they're more caught up on not hitting stop loss, or they're more caught up in the trailing drawdown and more than they are with the chart itself. Stop taking your attention off the chart. Because the moment you're so focused on your stop loss, you're no longer seeing what the candles and the chart, the price is, what it's actually doing. Observe yourself. This is why you're losing. This is why you're failing. This is why people lose. And trading, you have to grow as a person. You have to grow your psychology. There's a lot of growth that is required in this. But going back to what I said though, you have to be an observer. I want you to do this today. Write it down on your phone, on a sticky note. Get a pen, get a paper, write this down. Write down, I am an observer. That's it. That's all. That's all you have to write down. And when you, and I want you to take that paper and I want you to put it somewhere that you could see it. That you can remind yourself that you are an observer. So that you could remember what you're seeing on the chart versus what you see on the account balance. You're an observer. You're not a trader. Trading can come sometime else, but you're an observer. First off, you're an observer. Because a trader places trades. A trader is in a trade. A trader sells, a trader buys, a trader hits TP, a trader stop losses. You should be more focused on being an observer, seeing what the charts are actually saying, not being a trader. If you focus 90% of your time being a trader, you will lose money. You'll blow your account. I'm telling you the truth. I've done this. Be more of an observer. Be process driven. Be process minded. Look for your confirmations. Look for your confluences. Stop trying to be a trader. This is why you're losing money. This is why you suck. And I have to learn that the hard way. I've blown several accounts. And I'm sure I'll blow more, but at least I know this now. And today I've made my profit. I've made money. And right now I'm making this video. But everything that I just said is going to help you. And I'm not just talking to you, but I'm talking to myself. It's just me and you. Me, you, and God. Well, that's it. Thank you guys for watching. You have a blessed day.